Good morning, everybody. It's Wall Street Beats. We're here. It is August 15th, 2025. It's Friday. Earnings next week. Lots going on. And I see that the government might be taking a stake in Intel. Oh, so much wood to chop here in La La Land on Friday. Why don't we kick it off with Jeff? Jeff, we were just chit-chatting before we got online here on the air about Target. I know that you just did a little drop into one. I would love to hear your thoughts, your hot take on that, as well as looks like they're kicking out the cosmetics deal that they had. So maybe
Yeah,
wrap
that
that up in a bow for us on that.
inspiration for the visit was, I'd go to the stores all the time. I'd go there basically. My dad used to run Target. I kind of
Yeah,
it's where I visit dad.
yeah,
But so I heard that Target and Ulta were ending their deal, 5-year deal. They have
yeah.
stores within their stores. So within the Target, there's a little Ulta. Now, you might ask yourself, and I ask rhetorically, or anyone who could explain this to me in a way that makes sense, why the hell would
Yeah,
you give a big box makeup store a space in your, like, you're not a mall, you're creating a mall within a mall
yeah,
and its own check stand. It's confusing for customers, and it's the one thing Target's really good at selling. And they sell Elf right next to it. Like it just creates all sorts of strange problems. They got 600 of them out there out of your 2,000 store base. That deal ends next year now,
yeah.
which was a super smart announcement. If you look at those two stocks
Right.
over the last 5 years, they've gone opposite directions. Ulta has been about, been on just a tear. They
Sure.
both went on just tears. Target gave all of it back and then some, and Ulta's kind of just now it's about an S&P 500 equivalent performer. And we hear from Estee Lauder tomorrow. That opens up into earnings, which next week is really a big deal. With all the economic data we've had, Walmart obviates the need for most of your economic data. They're doing
Right.
they're $176 billion is the estimate for the lazy summer quarter for them. Probably half of that's grocery, give or take, and about 80% of the rest is imported. So
Mm,
you've got, a couple $100 billion of annual
right.
tariff exposure there. Walmart's prior kind of their feelings about the tariff, or that we don't really care. We win either way, but
Right.
it's going to be, they just, if you're doing $2 billion a day of business in the United States, you're probably going to have your finger on the pulse of what's going on. It eliminates the need to gather data to guess on import prices and service prices. It's like what's really happening right now today. My man Dougie McMillan will tell me at Walmart, the CEO of Walmart. And speaking of which, Target has a possible new executive. It's going to be a huge week next week. Wednesday earnings for Target. Thursday, you hear from Walmart. We also on Wednesday morning have TJ Maxx. So,
Uh-huh.
between Walmart and TJ Maxx, if you're looking for
Yeah.
someone who might have stuck the knife in the back of Target and taken them out a little bit,
Right.
they pretty much split it up between those two companies. But TJ Maxx, another one, they've had an atypically sort of mediocre year. Really good company, really smart merchandising. They don't have much tariff exposure at all. In fact, they could be a big winner off it because they benefit from the overstocking of other stores. I don't think Target's going to see great sales, but I also know a lot of these companies pulled orders forward so much
Right.
because of the tariffs coming that you could have a real clearance situation there, which works hugely to TJ Maxx's advantage.
So, but maybe break down a little bit about like how do we look at the data and find out what's a read on the consumer versus just a company taking share because it's better managed. So, how does someone next week, what would you be looking for next?
Your best economic indicator is going to be just a straight up Walmart, just straight up,
Okay.
and then get into the details on it and crawl into it because it's the biggest retailer in the world, biggest one in the U.S. obviously by far. You get a little dash of club store exposure. You get a little, you're going to look at comps there. They're expected to
Sure.
be pretty good. Amazon reported up 7% comps at their physical stores.
Right.
That raises the bar for Walmart a little bit. But in terms of an economic indicator, they're going to be great. It's a company like Target will get on with negative comps and they will
Right.
insist that they're taking market share. They just will insist it. It's no, we're taking share from surf shops like us.
Yeah.
The
Yeah.
taco stand, we're taking a lot of business there. I don't know where the hell they think they're taking share because Walmart is
Yeah.
just kicking their ass 9 ways from Sunday, and that can't happen. It's a bunch of other stores have kind of sort of subsumed the best part of
Right.
Target, the part that made it. Hey, look, it's a surprisingly affordable T-shirt, and I would actually wear
Right.
this. It's a lot of other companies have kind of taken that out,
Mhm.
but that's going to be for all those reasons. Walmart's going to be there. I expect them to take share. It's going to be their comps, not just relative to the economy as a whole, because I expect it to do
Yeah.
better than the economy as a whole. They're absolutely taking share, but you kind of take it in the aggregate. If you want a one-stop shop, you go for Walmart. Otherwise, by the end of next week, we'll have heard from geez, it's Toll Brothers, Home
Right.
Depot, Lowe's, Walmart's,
Right.
just a huge chunk of the entire consumer pie. And so you kind of take it as a grab bag. They're going to be mixed, just like we saw in the restaurants. Some of them are going to be disasters, but I expect Walmart to be pretty solid. I expect TJ Maxx to be solid.
Yeah.
Home Depot stock is getting frisky. Toll Brothers has been on
Right.
fire,
Right.
which is obviously an entirely different space. But it's like those two have to kind of go together, or one of them's wrong. But you're seeing kind of a little coil up, a little friskiness
Right.
in companies that benefit from just cutting rates, whether we need it or not.
Total data point of one, but I've got, one kid headed over to college, and I did most of my shopping over at IKEA for all the knickknacks and everything. The deals were incredible. The ability, I mean, they'll deliver everything, which for it's a lot of dumb stuff to outfit a dorm, right?
Yep,
Deliver it to
yep.
the house for next to nothing. Obviously,
It's
Amazon, you
beautiful.
can do the same kind of thing. So I didn't even step foot in a Target, which I think that,
Right.
5 years ago, that would have been the first place that I took my kid.
And Target just has to own that. That
Yeah,
just
right.
has
That
to be
that
something
should
that
should have been theirs, right? But if the first thing on a site
exactly.
at IKEA is like, outfit your college dorm, and then it has like each bit, all the styles, everything, it just made it so much easier.
And
But
about
anyways,
20% of Target is going to be stuff that you buy, household goods, coffee makers, and
right.
little furniture knickknacks and things.
Knickknacks,
Like you
yeah.
say, you don't even set a foot in there. You don't
Yeah,
even look at it anymore. And
right.
they don't have much of an online presence. They at least have to be part of the conversation. Anywhere they're close to a college, that should be they should crush that. They need to
Right.
own that market the way Lulu would see a woman in tights,
Right.
and if she looks
And
particularly
think that that's
good,
gonna be my thing. Yeah.
it's my
Um,
person. That's
right.
the thing. And so Target's not hitting that customer, so they're not really doing much.
But we were talking also about the fact that when something is so hated, all you need is, hey, we're gonna replace the CEO, and you could see a massive pop. So when everyone's betting against something, you got to be a little bit careful joining into the crowd of hate. So is that fair?
Totally. And the real big takeaway from my visit isn't that the crap on Target. The market's done a pretty good job of that over the last
Yeah.
3 years. Pull up a chart and I don't have to say a word. There's just lots of low hanging fruit. There's lots of stuff that they can do that a new CEO could do, and just give them a mandate. If they hire from within, I'm not that impressed with the team. So I'm not sure that anyone there has earned a call up. I think if
Mhm.
they went in and they say stole Laura Elba from Williams Sonoma, she's a player. She's hardcore. She'd be from the outside. She has a clear vision, and that shouldn't be a huge step up. People say, well, Target's a scummy discounter. Why would she go from fancy Williams Sonoma? Because Target's supposed to be nice.
Right, right, right.
It's
They tried
supposed
to
to be
put
a
Kate
clean
Spade
place.
in it.
You
You're
can't
trying to
put
get,
Kate Spade in a place.
yeah,
You can't have your clearance racks so
right.
filthy that there's stuff falling off the racks like that. That's a real problem. It's they have kind of just stuff up front is empty shelves and depressing areas. A new executive with just the clean man, come in and say, clean the stores. Let's get the stores looking high and tight, and we'll start there. And just a person who would stand for something. You really could see a 15% pop in this thing if they hire
Yeah.
from outside. If they came out and said, you know what, we're taking a CEO from the outside, we're going to break with tradition and get some fresh thinking in here. There's a lot of stuff you could do with it, but it's not happening yet. Makes it
So
a tough
going in,
trade, but maybe a
yeah,
follow on. If you get
yeah,
a good enough CEO, you're going to get a few quarters run out of this, just
right.
as all new CEOs do while they turn things
Right.
around.
So going into earnings, are there any bets that you're making, right? Either something that you're large in that you're a hold on, or is anything that you're buying and selling right now?
I loved Amazon's quarter. We're going back a week or so, but I think that's going back to all-time highs. I think from a retail perspective, crushing,
Right.
crushing, crushing. Still long Walmart, have been for years. Feel a little trapped, but also if I'm going to be trapped, this is
Right.
a perfectly fine
It's a
place
good
to
place to
be.
be.
So a little expensive in terms of stocks that like I said, TJ Maxx was a little disappointing, and I think they've got a decent amount of upside if there's any consumer at all, just because they don't have to sweat the tariffs. They're not going to sit in there and talk about tariffs the entire conversation, and there's
Right.
going to be extra product from all the pull forwards that we saw, hitting
That's
the
true.
inventories,
Yeah.
and Home Depot was already set up for Halloween and have been for a week. It's going to be pumpkin spice season next week. This is
Yeah.
it's
Yeah,
the holidays.
totally.
Happy holidays, and
Yeah.
let's see how the holiday season's doing. But a lot of that stuff is going to be in the clearance racks at TJ Maxx before Christmas even gets here, and that's great. So they could actually potentially benefit just the way
Right.
Walmart would. They are going to take share no matter what, even if the tariffs
Right.
hit their bottom.
Speaking of clearance racks, I know that Robert likes to get the small cap clearance rack. He finds a lot of good value there. What do you have for us today, Robert?
I'm cap independent. I'm growth and valuation dependent. As Jeff has proven, you want to own the expensive retailers because they're kicking ass. You don't want to own the cheap retailers. They're getting their butts kicked, right? We've put the idea of buying down and cheap retailers as a bad idea about a year ago on this show. All three of us.
But you know what? They're getting frisky.
Yeah.
Look at Kohl's. Look at Kohl's, which looked like the
I was
dumbest rally in the
Right, right.
history of rallies. You take the debt pressure off these things, and Coiled Springs. Yeah, you don't want to actually want to shop there. You don't want to live there, and you probably don't want to be long the stock.
I had a visit to Hell's Waiting Room yesterday. I had to check out at both Kohl's and home goods stores.
You should stop by the DMV after Kohl's and see if you
Yeah.
can notice a difference.
So anyway, two of my small caps, my last two small cap companies reported this week, and it was nice to have two good reports and
Right.
two very good stocks. So my Canadian battery company, Electrovaya, which I'm in at a high two handle last, maybe a year and a half now, probably 280. Something like that. It's about 475. So it's starting to come around. It was a disaster for the first year and much of last year on this show. I kept averaging down, unfortunately. But
Okay.
they've turned the business around. They grew top line 76%. I think next quarter is going to be 90%. They make a unique battery that doesn't, for lithium ion, that lasts 5 times longer than the average normal lithium ion battery, but doesn't catch on fire.
Oh,
People
that's
know.
a good feature. That's a really good feature.
Good feature, smart.
Yes. Last December, it was a battery farm in California that caught fire and $400 million worth of lithium ion batteries burned up. So I told the CEO to send a salesman with a flamethrower and one of those flame retardant suits to the CEO's parking lot and put a battery on the floor and try to show him it doesn't burn, and maybe he'd get an order from the electric utility that just lost $400 million in batteries. They didn't think that was a good idea. I did. Anyway, so they're starting to, they started in forklifts, and they're growing now into data center storage and applications, construction equipment, heavy duty trucks, all kinds of. Corporate America is doing relatively well.
Right.
Customer, you're in business. I'm not a big consumer fan. I'm not a retail fan, so I do own a shoe company here and there, and I got involved in Crocs a little early, but it's not my thing. It's U.S. consumers. The business to business market is strong. Electrification is still a very legitimate theme, lucrative theme in corporate in the stock market today for the companies that have the right products. This company, Electrovaya, has the potential to grow. I don't know if they stink 30% a year, and if they execute well, 60-70% a year.
What's the ticker again for people?
LVA. It's a
Thanks.
very small cap. That's only a couple $100 million market cap after it doubled for me. So it's very hard to buy.
Get shares.
But I'm going to own this for 5 years, and a 5 to 10 bagger is my hope.
Nice.
The other company that reported was TAT Technologies. It's an aerospace parts and service company. Commercial aerospace is their big market. They do a lot of MRO, maintenance, repair, and overhaul for airplane.
Okay.
And they are an Israeli headquartered company, but all the business is based in the U.S. And they've started the process, move the business to U.S. listing, move the company to U.S. listing. And that was a mid-teen purchase on Wall Street Beats last summer. I think it's just gone long-term in the 15 to 16 range, and it's 36 today. And I've only sold a quarter of it, so thank God. And that was a lot more than it is today. But they had a mixed quarter. They grew revenues 19%, which was a very big disappointment because they've been growing in the mid-30s.
Okay.
One of their divisions had a lag in orders, but the CEO said the orders came roaring back since the start of the new quarter. So that's starting to get a little expensive in that I have them making, $1.50 next year and $1.55 this year, $1.60. So it's 36, at $40. It's, I had them going from $16 to $40 in 2 to 3 years when I published on it a year ago on the site. So, It's a 15 to 20% compound revenue grower for the next 5 years, I would hope, because
Okay.
they didn't service one product called auxiliary power units, which is a small jet engine that runs the power to the plane when the plane's not flying, and it's backup power if there's an issue with the engines. And they never serviced that market, and they got
Okay.
licenses to serve it for Honeywell, which owns that market. And Honeywell licensed them to help them because they had a 3-year backlog in servicing. And their TAM in this business is about a 40% of the company went up about 10 times when they got the ability to service the Boeing 737 fleet and the Airbus 8200 fleets. It's just all they have to do is take a third of the share in these new products that they have in their old MRO with the other Boeing and Airbus cargo jets. They would like triple the company over 5 years. So it's a very cool story, and it's becoming a U.S. company. So usually there's an arbitrage between Israeli companies at 10 times earnings and U.S. comparables trade at 25 times earnings.
Okay.
So 25 times, $1.50 is a fair price target if you ask me. And when you buy them at 10, I bought it a year ago at 15, and I had $1.25 estimate for this year, which they're going to do. I paid 11 times earnings for it. Now it's in the mid.
Yeah.
So I'm
Right.
not, I'm not very, it's a strong hold for long-term compounding, but on a short-term basis, both Electrovaya and TAT have had very good runs on good news, and they need to consolidate.
All right. Anything else in terms of what you're looking at? Do you have any earnings coming up, or are you searching for new ideas right now? What are you working on?
What I work on now is I maybe it's the new low list, the list of death,
Okay.
because what happens this time of year is that companies' stocks that have been bad stocks in a good stock market where people have lots of gains, they're going to look for
Right.
offsetting tax loss. Now, institutions that are tax advantaged, they don't care about taxes. Many
Right.
times they don't care about taxes if they're not, tax advantaged money. They trade what they want to trade. So there's another term that I've coined called face loss selling. And at the end of their fiscal year, which is typically in the fall, September, I believe that they don't want to publish their big losers.
Okay.
So
So it's like somebody with like a massive Novo Nordisk position or something.
yeah.
Like they just don't want, they want to
don't
show.
want it in there. They don't want to admit that they own that piece of crap all year, right? So,
Yeah, right.
And it feels so good to sell a nice piece of crap. Is there any
right,
feeling
exactly.
better in the world?
Publish the
Discrimination.
report, and you publish your stocks in the your portfolio, and you add a report, and it stays around for a year. You don't want to show that piece of dung, right?
Okay.
So the institutions sell the new low list just because
Okay.
of face loss, and that lasts through September, October, and then individuals kick in October to November to do tax law selling. Now everyone thinks tax law selling is December, but everyone also
Right before, right.
they're going to beat the crowd. So I got to do it in October, November, because everyone's going to be doing it in December. And I don't want to sell into that. So it tends to peak in November. So in October and November, I put together a list of companies that have had short-term glitches, short-term hits, but I start shopping the new low list for companies that have just, stumbled as a growth company. I start, doing research on a list of things I intend to buy. If we get a stock market correction, which we're, definitely overdue for 5% maybe after this massive run, but I would think if you can get the tax face loss selling and a 5% correction, you could pick up some distressed merchandise, but that doesn't mean buy companies that are bad companies that are screwing up, that have no growth, no future. You just have to buy companies that have had a temporary hit to their story, and the story can come roaring back, in the future. So that's what
I've got my eyes on one in Europe that it's actually quite a large tech company that was on the Merrill Lynch list, right? The B of A, the BAMA list of companies that are going to get eaten away by AI. And by the way, Google's on that list, right? So, you get one of those where people just like, oh, holy crap, they sell that. They don't want to be owning it because they don't want to have questions, but that they have huge installed bases. They actually do some of the greatest consulting in AI over in Europe. You pick up those kinds of things, but you're right. You have to be careful on the entry because you want to get through that period of people throwing the stock out and not wanting to own it. So the timing on that, like right now, might be a little bit too early. You could probably maybe put a little toe in the water, but you have to be a little bit patient here because you do have those other headwinds. And the fact, wasn't it's a Hartnett too also came out this morning, right? And said his prediction, I love how they always the predictions that is after Jackson Hole that people will sell into the strength of the year-to-date returns. So you might be getting your Christmas early, Robert, with that 5% correction.
I've gone from no cash at the beginning of the year, 25% cash in February, no cash in May. It took me till May to buy off the bottom. A lot of the buys were shitty because I was buying my laggards. What you learn about laggards is the stock market is picking up the bad news that's going to be, displayed in the next earnings report. It wasn't the most, buying my fundamental winners was definitely, even if I paid up more, it was more attractive in the short run than buying my losers. No, it's something that, I'm back up to 15% cash now by selling some winners that just got expensive and also trimming some of the losers that aren't going to deliver. I would expect to buy them back at these
better prices
in the next 2 to 3 months. Exactly. Now I do have consumer experience with one company, and Jeff knows I got my Skechers stolen from me by sleazy management, and I was itching to put the money back to work. So my consumer story was I went into Abercrombie at 100, sold it at 100, went back in at 80, sold it at 80 because I didn't know how to analyze their new normal income statement, thinking I was safe. And I had to get that money back into one consumer stock because I always have to own one. And I bought Crocs at 100 out of boredom. It's like, it's down to $50.
Bet you're not bored anymore.
I did a 1% position. I don't lose sleep over losing 20 points on a 1% position, but a normal position for Crocs would be 5, probably 6 if I was 5% in Skechers, so it was a small fraction of the money. And Abercrombie obviously was a better buy so far. It was easier to analyze Abercrombie than Crocs in hindsight. But my logic on Crocs is very, very simple. U.S.-centric consumer companies have very little opportunity for revenue growth organically once they saturate the U.S. market. And that's brands, apparel brands, shoe brands, as well as retailers who sell their own brands and other people's brands. I don't think there's any moat in retailing unless you get to scale. And there's only a handful of companies you can buy there. And that's Walmart, Amazon, Home Depot, you name it, right? There's 10 companies the most that have scale there. And the market pays for them because they recognize that they have this defendability, right? So the reason I like Crocs in here, if and when I get normal at the right time, it's because they have 50% of their business that's foreign. And the Crocs phenomenon is really never taken off abroad as well as it has in the US. So if they have 50% of their business growing 15 to 20%, that's 8 to 10% top line growth for the corporation. So all they got to do is not grow in the US to be an 8 to 10% organic revenue grower. Not many retailers or brands in big cap land can say that. Now, there's always something hot in footwear that's going to catch on and, rock moonshot up and moonshot down. But, I tend not to play those companies. They tend to be too expensive for my valuation taste. So that's the logic with Crocs. I thought their operating margins were sustainable, even though they were high because they had done them for 4 years. And now that they've been marked down from high 20s to mid-teens, I think you're safe with the operating margins being here. And, they cut the numbers from 13 to 10, and the stock went from 100 to 74. So it was still always a double-digit free cash flow yield and a high single-digit P ratio. So what if they do $5, the stock's going to go to 35 or 40? Give me a break.
And those shoes, man, there's a whole closet full of them. That's been the death this year. They were so hot for so long, and
a lot of people
they took out tech. The Skechers was a smart sale,
and that's the risk. The risk isn't that there's no valuation risk, and 7 PEs aren't discounting a lack of growth; they're discounting big negative growth.
Yeah. And so, what do you think about that, Jeff? The Crocs trade?
I think it's a good trade here. I'd like. There's always a buyer out there for a 7 PE thing like Crocs. It's if they have to go into the arms of private equity, someone's going to suck them up for
10,
5-6
9,
times that next year's earnings. So that's going to give you a
Yeah.
base on that at the very worst. I
As
think
long as
that,
the
and we're
CEO
not buying
doesn't.
the glory ones anymore right now. They're selling OnCloud. On Holdings had an absolutely magnificent quarter. I mean, my God, it was they destroyed high estimates. They guided higher. It was beautiful, and I sold it, and I saved me 10%. Now, what are those? Those ons or Crocs? They're
These?
beautiful. Those
Yeah, these
gorgeous
are
shoes.
amazing. I'm just saying though, I think these are Amazon. Just get them
These
off
are the
Amazon.
original
Love
Crocs.
them, love them. The only problem is like once you have them, they don't wear out very easily.
I've had to switch from buying all Skechers to buying Crocs now.
Yeah.
As long as the CEO does an LBO Crocs at a shitty price, I'll be happy. That's it for me.
All right. Well, listen, we're here at 7:27 West Coast time, 10:27 East Coast time on August 15, 2025. Thank you to Robert Marson, Jeff Mackey. I'm Nadine Turman for Wall Street Beats. Have a wonderful weekend, and we will catch you back up on Monday. Thank you so much.
Thanks, guys.